basically economies are downstream of markets. Markets are driven by liquidity or money flow. That's certainly in our framework. Freighters are expensive to hire. They use a lot of working capital, and higher oil prices make a difference. It's not debt GDP that matters, it's debt to liquidity, because debt needs to be refinanced. And if you look at this diagram, what it's telling you is that there are two legs to that refinancing. The $64,000 question is not, will the Federal Reserve come back in? Is when will the Federal Reserve come back in? Because it will, we're just debating the timing. Don't trade Bitcoin or gold, own them. And it's really as simple as that. They should be part of a core holding because they're monetary inflation hedges. And we're moving into a world where the only thing that governments can do is to monetize the debt they've got. The power they have is to print money. And so what the real threat is monetary inflation. And that's why you need to own these assets.
Today, we welcome back Michael Howell, liquidity expert. I'm Nick Bhatia, the Bitcoin Layer. Michael, welcome back to the show.
Nick, very good to be here. Hi.
Move index has fallen over the last several days, and that way bond volatility has come back down, and that's been a little bit of a boost to liquidity after it has sharply turned lower. What is the outlook here on liquidity? Are we in for a bounce, or is the cyclical top in?
Well, I think the answer is that the cyclical top is in. I mean, it's happened already. That cyclical top occurred about September, October of last year on our reckoning. And liquidity conditions have been weakening really since that point. I mean, you can see that, I think, evidence in the markets. The move index is one of the factors that controls the collateral multiplier, which is important in terms of understanding liquidity generation, fell significantly. It then jumped during this Iranian tension. It's pulled back a little bit in the last week, as you rightly say. It's, that has to be a positive indicator, but you've got to set that in the general context of many, many other things going on, and it's probably not sufficient to reverse the trend. So it's helpful, but it's not crucial.
And tonight we have President Trump's quote unquote deadline here. So we're recording on the morning of April 7th. In order to make sure we're keeping it current, what do you feel the war has what do you feel the impact of the war is on this turn in liquidity? Or do you see the turn in liquidity happening, several months before and really giving either a leading indicator or completely distinct from this geopolitical event?
Well, I think it's distinct. One's going to say, as a result of what's happened, it's not going to be helpful for liquidity. And I'll come on to that in a second. But, the way that I see things is that, basically economies are downstream of markets. Markets are driven by liquidity or money flow. That's certainly in our framework. Economies are downstream of that, and geopolitics are downstream of economies. So I think the primary factor in terms of the cycle, in the way that I see it, is what's happening to the liquidity cycle. That's a dominant, 5 to 6 year cycle that affects everything. It's not to say that geopolitics aren't important, but it's very, very difficult to actually see, if you look back at charts of market performance, where big geopolitical events have occurred. It is really hard. You can definitely see cycles in monetary conditions. I mean, that shows up pretty clearly in the waves in markets. But geopolitical events, although they feel tough at the time, and economists sort of go to great lengths to actually say this is the end of the world or whatever, it tends not to be in many cases. The world moves on. Now, clearly, the stakes are being raised here by President Trump, and we'll see what happens, what the outturn is. And one would suspect that, everybody is sensible enough to pull back from the brink. But you've still got to reinforce the point, and we've got to reinforce the point that these Iranian tensions are not helpful really to markets. And I think you can see that in a number of ways by sort of counting the cost in terms of three particular conduits. One is that we've got to remember that the oil industry overall is very liquidity and credit intensive. Cargoes are tied up for months. Freighters are expensive to hire. They use a lot of working capital, and higher oil prices make a difference. And we reckon that every $10 on a barrel of oil probably reduces global liquidity by about 3%. So that's a fairly meaningful change, given the fact that we were, around $70 a barrel before this tension. we're now 110 plus. So you've seen that's probably taken out about 10, 15% out of global liquidity just by itself. So that's a big effect. And then you've got to add into that what's happening to the move index. The move index is important, as I said, and we would reckon that every 10 points on the move probably, as a rule of thumb, would take about 4% of global liquidity. Now, if you said that basically prior to this crisis, we were around about the 65 to 75 range, and we're now probably 10 points above it, you've got to add, but or rather subtract another 4% out of global liquidity for that as well. So you're getting up to the sort of the high teens figure. And then on top of that, you've got the dollar. And basically, it's almost a one-for-one move in terms of a 10% increase in the DXY, probably subtracts about 10% from global liquidity. Now, what have we had out of the DXY? Probably something in the order of a 3 to 5% move. So you add all those factors together, and you're really talking about around about a 20% hit to global liquidity from this crisis alone. Now, as I said, that's not the crucial factor in determining the liquidity cycle, but it is reinforcing a downtrend that was already underway. So the inflection occurred regardless of this Iranian crisis, but the Iranian crisis has clearly made it worse.
Okay, I want to ask you about the measures within liquidity that are the money flow measures driving this in 1 second. But first, let's go back to oil. You say $10 increase in oil is a reduction in global liquidity by 3%. So a massive move here in oil, sucking liquidity out of the market. Now, is it because to purchase the oil, you need to sell down assets such as treasuries, and that itself is causing, by a move higher in interest rates, a fall in collateral value? Is that the mechanism that's driving that drawdown in liquidity? You mentioned how much working capital freighters use and how credit intensive the oil industry. Please walk us through the mechanism, some of the math here as to why liquidity is hit when oil goes up.
Well, I think it's really a simple question of saying that all money that's anywhere must be somewhere. And if it's in the real economy and it's paying for increasing working capital charges in the energy industry, it's not in the financial markets driving asset prices higher. And broadly, if you look at the run through a statistical analysis, which is how we've calculated this, what we find on our estimates is that the effect is around about per $10 a barrel on the oil price, you get about a 3% drop in liquidity. It's a meaningful and very significant effect, but it's one amongst many. But what I'm saying is that these things are sort of coming together. So you've not only got the oil increase, you've got the move index, and you've got the dollar as well. So they're sort of compounding together. But generally speaking, it's just the fact that if you've got a strong real economy, you tend not to have strong financial markets. And that's one of the paradoxes, but we often see it, as market participants. You normally tend to find that stock markets are racing ahead at the time when the economic headlines are looking really bad. And then when the economic news looks really good, people are baffled and scratch their head by the fact that the stock market tends to be going down. But that's the way of the world. It's just the simple fact that money can't be in two places at once. If it's in the real economy, it's not in the financial sector. And what's driving these markets is money flow.
Introducing TBL Pulse, our new incredible terminal packed with macro, liquidity, and Bitcoin data, actionable information to help your portfolios. Get full access to TBL Liquidity, our proprietary metric that helps you get a beat on risk markets with a high correlation with Bitcoin and the stock market. This is the terminal I use every day to understand where liquidity is and how the Bitcoin market is functioning. If you are already a TBL Pro subscriber, TBL Pulse is available to you right now. But for the first time, if you're not already a pro, TBL Pulse is now available as a standalone product. Go to thebitcoinlayer.com to find out more. Is that similar to the effect that TGA has on liquidity in terms of Fed liquidity? When the government has money in TGA, it's not being spent in the economy, and when TGA draws down, money flows into the economy. Is that a metaphor here that we can use for the way to think about how oil impacts global liquidity?
Well, it's a tad different, Nick, in the sense that the TGA is basically a balance that is not circulating. So it's money that's withdrawn out of both circuits, out of the financial circuit and out of the real economy circuit. Now, when that is recycled when the TGA is run down, the TGA is normally run down by money going back into the real economy. So that's something that's what I would tend to argue. So it's similar, but it's really distinct from, if you like, money that's being injected directly. That TGA money may ultimately end up in the real economy, but one's got to see the funding pattern. And that's one of the things that we talk about when we discuss this shift from Fed QE towards Treasury QE. Now, Treasury QE is a connected phenomenon, and probably that is the best way to understand, maybe this particular oil conduit. And what's happening with Treasury QE is this is a change in the funding dynamics of the US government, whereby there's an awful lot of bill issuance, as we know, going on now. And one would imagine with heightened defense spending, there's going to be even more bill issuance being undertaken. Now, the question to ask is who is buying those bills, and who tends to buy bills and very short-dated government debt are banks or credit providers. And if banks or credit providers buy debt, they monetize that debt. And that is what's really going on now. So what's effectively transpiring with increased US government spending is that it's being monetized directly, it's being funded through treasury bills, and that is being bought by banks, and they're monetizing that. So if you look at the US monetary aggregates, for example, M2 just recorded, I think, an all-time high yesterday on the data release. What that's actually telling us is that a large component of that is being driven by this monetization of government spending. So that's how I would tend to think about that. And what you've got with higher oil prices is actually a withdrawal or a claim on that liquidity pool, a similar claim on that liquidity pool. The point about Treasury QE is that is taking money away from the financial sector, similar to higher oil prices. So it's money that is going into the real economy. And as I go back to say, all money that's anywhere must be somewhere. So on either count, if money is leaving the financial sector, then it's not going into it's not there to drive asset prices.
Are you saying that the rise in M2, which is a liquidity metric, that because it's accompanied by a rise in oil, it means that money is in the real economy, not in the financial market? So it's actually punitive in this case. And is that different than cases past?
Well, I mean, the first thing to say up front is that M2 is a very bad liquidity metric. It's one a lot of people use, but it's not an appropriate one. And the reason it's not an appropriate one is that the world has moved on hugely from when M2 was created. M2 was, is something that one thinks about probably without being, too disparaging about it in the 1950s or 1960s. It was largely associated with a lot of the work that Milton Friedman did, particularly in his pioneering study of the US money supply data, which was published in 1963. And that was probably the sort of the pinnacle of importance for M2. Now, the problem is that since that date, we've had a lot of financial innovation. If you are telling me that retail or high street banks are the main sources of credit in the US economy, I'll come quietly, but they're clearly not. There's a lot of other very important institutions that can create liquidity. Evidence shadow banks, evidence the repo markets, evidence the use of collateral and whatever else. These are now the important factors, and they're not in the M2 statistics. So what we need to understand is the difference between what M2 is telling us and maybe what broader liquidity measures are actually saying. Now, M2 is probably not a bad indicator of money in the real economy because banks, high street banks, tend to intermediate quite a lot of that through consumer spending and maybe working capital finance. So in that regard, maybe M2 is not a bad, heads up to whether you're getting a strengthening or weakening nominal or NGDP, nominal GDP measure. It's not a great measure for money in the financial markets, that's for sure.
Excellent explanation, and an important one, because what you teach us is that global liquidity should be measured by the asset base of the system. And while M2 is just a sliver of the liability side, and that important lesson has underpinned a lot of our study at TBL with our own TBL liquidity index, that in many ways, Michael, we used your liquidity index to inspire, but taking a different approach or our own approach with it. I want to ask you here about SLR reform. Now, you mentioned these credit providers, these banks that are going to be absorbing T-bills or are already in the process of absorbing T-bills as fiscal deficits get spent into the economy. So is SLR reform going to accelerate that process, make it easier or not really material to you?
Well, I mean, I think it's a very complicated question, Nick. I think there's, as you know, a sort of a wider study of what's going on. The Fed has published a discussion paper about how they could cut the size of the Fed balance sheet and actually offset that cut in the Fed balance sheet by relaxing a lot of the constraints on banks, and one of those being the SLR. But generally speaking, what is being envisioned is a reform of Basel III, which is really a set of constraints on banks which restrained their lending after the GFC. I think there was understandable reason to try and control the banks. But the problem is with the financial sector, as soon as you try and regulate one area, it sort of slips under the net, or you sort of get it a bit like trying to sort of catch the soap in a shower. It's very, very difficult for the regulators to do that. So as soon as you start to regulate something, it sort of appears a bit like squeezing a balloon, another analogy, it appears somewhere else. And that's broadly what's going on. So the shadow banks are not really regulated in the same way as the high street banks are. And I think that, what the administration is probably trying to do is to, first of all, level the playing field more, and to give the Federal Reserve probably more of an ability to actually support, let's say, the broader capital markets. And I'm talking here of the collateral markets generally. So they're recognizing the fact that shadow banking and collateral and repo markets are really a crucial part of the future. So I think there's that. And maybe to free up the banks from what were onerous regulations on them. So I think you've got to think about this whole thing generally. Now, the subtlety in this is that maybe, and I'm going to fess up to maybe being guilty of this too, is that people are kind of not thinking too much about the timing of these proposed changes. And one of the things the administration has been fairly clear about is that they think they can almost exactly offset the reduction in the Fed balance sheet by a similar increase in private sector liquidity, if you like, through the banks. In other words, by having fewer constraints on the banks can expand their balance sheets and offset any shrinkage in the Fed balance sheet. So actually you get a net positive. And the other factor that is really part of their thinking is that they would argue that the Federal Reserve has its biggest impact on the financial sector, whereas the banking system has its biggest impact on the real economy. And therefore, if you want to promote stronger productivity growth, you've really got to take these constraints away from the banks. Now, I buy all that. I think it's very sensible. But I think that maybe I'm not going to say the error, but I mean, maybe the subtlety in the thinking is to say, is that everyone is immediately assuming that the drop in the Fed balance sheet will come at exactly the same time as the expansion in the banks' balance sheets. And that may not be the case, might it? It might easily be the case that they do the reforms first. They allow banks' balance sheets to expand significantly. And then sometime in the distant future, the Federal Reserve feels it can actually pare down its balance sheet. Now, that would actually allow for a significant liquidity boost in the medium term. Now, I'm not going to say that's going to happen, but that might be, some sop to our general pessimism right now. And I think that's something to bear in mind. And, the fact is that if you deregulate the banks, as we've seen so often through history, particularly looking at the early 1990s, you get significant liquidity expansion. And that may be the case this time too.
Okay, this is really good discovery, especially because you just made the point that maybe we're not thinking about this enough. So I want to keep going and play devil's advocate to the drop in liquidity. What if the the timing is such that deregulation of the banks happens, wind down of the Fed balance sheet is not going to happen yet because the former has to prove itself out to be effective? You do get a productivity boost, and the lending of private sector lending physically gets into the system. Let me ask you a two-part question. Why did you say that maybe we're not thinking about it enough? And how soon could something like this happen based on what you're seeing with regulation changes specifically in the administration?
Well, how soon is a very difficult question to answer, because we still haven't had the new chair Warsh sanctioned yet. I mean, he's not been approved, I should say. That's still set to go. So when he gets in place, maybe there'll be some guidance as to what can happen. There's clearly a desire to deregulate the banks and try and trim this Basel III Accord, the US is in a prime position to persuade other countries to do the same. And I'm sure that a lot of other countries, I mean, we're talking here really the Europeans, would kind of come along with that idea too. So I think Basel III is probably, on reflection, too onerous. So I think there's probably pushing an open door in terms of bank deregulation there. That will increase liquidity. But I would think this is much more likely to be a 27 event than a 26 event. So, there can still be some volatility in markets near term. But the fact is that, what we're looking at here is a situation whereby the private sector is being, unleashed, or that's the attempt to unleash the private sector to create liquidity. That has happened many times before. It hasn't always ended well because you tend to see big asset booms as a result. But I think it's one of the things that needs to be done. If a lot of these, or if a lot of the, the problems are going to be solved in the future. I mean, one obviously being productivity. Banks lend to small businesses. Banks are really the key to boosting productivity growth, and that's something I think needs to be done fairly badly. And you can see it really right across the West that investment spending has been in the doldrums for a long time. I know there's a surge in AI spending right now, but it's really across the broader economy that we need to see a productivity uplift. And it's the banks that are really in the prime position to do that. So I can see the arguments and buy the arguments about why deregulation is necessary. But I don't think it's going to happen overnight. But I would say look more to 27 as some sort of inflection point. As regards the Fed, I cannot see, and I don't think he's able to do this anyway, new chair Walsh coming in and basically slashing the balance sheet. I mean, it's impossible. You couldn't even contemplate doing that for the simple reason, look what happened late 25 when there was 200 billion that basically left money markets because of a rebuild of the TGA. That was enough to cause serious spikes in the repo markets. And it actually prompted the Federal Reserve to come in with another intervention, another QE program, which was this reserve management purchases, RMP. And those have actually proved to be fairly substantial. They've actually been sufficient to actually reverse the QT and actually embark on or underscore a significant new QE program that the Fed is undertaking. So there's no way they could pare the balance sheet back seriously in the near future.
Did you know that TBL liquidity indicator flagged this current bear market on January 14th? Make sure you guys are signed up for TBL Pulse in order to get information on when the next green dot and positive liquidity wave are in store for risk markets. Every morning, I open TBL Pulse to track the slope of the cycle, look at Johan's Bitcoin charts, and give myself an edge on all the macro information out there. Every single piece of macro, liquidity, and Bitcoin data that you could ever want, all in one place, available to you, updating all the time. I am genuinely in awe of what we have created here, and I can't wait for you guys to check it out. Go to thebitcoinlayer.com to find out more. Yes, the repo market spike in Q4 of 2025 was a clear indication that reserves that the Fed thought were ample were simply not there, and they had to inject them back into the system. So if the Fed is increasing its balance sheet again, what are some of the major measures within your money flow statistics that are contracting, causing this huge topping in cyclical liquidity back in Q4?
Well, the answer it really comes down to many factors. I mean, I've cited some of them, the more recent ones. So you've had evidence of higher oil prices, etc. You've had strengthening dollar. You've had increases in the move index. Those are factors. I think the other factors which tend to be weighing more on the system is rather less central bank tightening. In fact, there's no real evidence of central banks tightening over recent months at all. In actual fact, things are fairly steady in terms of the pace of liquidity injections by policymakers. What's really happening is private sector liquidity is shrinking back. And that's coming from a number of factors, but it's largely because of a recovering economy. Now, we can debate whether the economy is currently in contraction or not. But, I would say that if you look at the data that we look at anyway, would tell us that although, as bad as this Iranian conflict seems to be right now, it's not really having a huge effect on the real economy. On our estimates in terms of world GDP growth, it's having an effect something like about maybe a half to three-quarters of a percentage point so far. That's what the data is telling us, looking at a daily nowcast. And, admittedly, that's only been going on for, 5, 6 weeks or so. But nonetheless, that seems to be the impact. The tariff tantrum of about a year ago had a much more material effect on the world real economy, an effect that was probably 2 to 3 times what we're seeing right now. And if you go right back to the time of COVID, that was a hit that took world GDP growth down about 4 or 5 percentage points. So, we're looking at something which is material, but it's not the end of the world in terms of the world economy, and certainly how what the data is showing up right now. Now, clearly, if it's sustained, but those previous two occasions were short, sharp shocks, this could be sustained, and then, I'll agree that maybe the impact on the world economy could be bigger, but so far it's not that great. So in other words, what you've got is an economy that was anyway in recovery, that is increasing its working capital demands. Those working capital demands will be added to because of higher energy costs, of course. And then you've got on top of that effects such as the big AI spend in the US, which has caused a lot of the major tech companies to go from huge positive cash flow balances into now needing to borrow from markets again. So that's been a huge, huge turnaround. And as they come back to the point, all money that's anywhere must be somewhere. So if it's being channeled out of treasury departments or in these tech firms in Oracle or wherever it may be, and shifted into Capex spend, then it's not there for financial asset purchase.
This is such an important point that helps us understand this drawdown in liquidity. The source of it is actually a strong economy. So what Michael is trying to explain to us is that when the economy is booming as it is now, especially on the investment side, that money has to come out of financial markets necessarily. So let's get into the corporate bond market. Can you explain the mechanism there to people? These hyperscaler AI investing companies now, instead of reinvesting profits into share buybacks, they are going the other way and hitting the investment grade bond market with huge issuance and even out to 100-year terms with some of the larger tech companies. And now that money is coming out of financial markets. Explain that mechanism to people so they can understand more what you mean by that the recovering economy itself is the source of the liquidity drawdown.
Yeah, well, I mean, those tech companies are doing that if they can. I mean, only some are able to, but if they can issue longer duration debt, longer maturity debt, in other words, they'll do that. But these issues tend to, well, they typically absorb a lot of liquidity, and if you're holding a longer term bond anyway, they're taking up quite a lot of balance sheet space. In terms of the regularity requirements for longer dated, potentially more volatile corporate debt. So these are factors that you need to take into account. So in other words, if you're doing a lot of issuance, particularly long dated issuance, it's going to have a much more negative effect on liquidity than either not doing it or actually even issuing very short term paper. And that's the reality. So what you've got is a withdrawal of liquidity or a loss of liquidity out of financial markets simply because it's absorbing more supply. And that's a simple fact. As I say, keep repeating, all money that's anywhere must be somewhere. And if it's in one place, it can't be in the other. And that's really the situation. For the last, 3 years, we've had the luxury of a very sluggish economy where economists were always telling us we're just, nearly in a recession. In other words, that economies were just sort of bumping along the bottom. They didn't have any particularly high demands, for liquidity or credit. And as the great investor Stanley Druckenmiller once said, the best time to invest in markets is when you've got a sluggish economy that central banks are trying to goose because they're putting more liquidity in. The real economy is not absorbing it, so it's got to be somewhere, so it's in financial markets. And that's simply what we've seen for much of the last 3 or 4 years. Now, there's another factor that we've got to start thinking about, and that is this so-called debt maturity wall. Now, hopefully you can see this slide, which is entitled the Debt Maturity Wall. And one of the things that has occurred in the last few years has been a terming out of debt that was encouraged in size during the COVID crisis by authorities slashing interest rates to near zero, or in cases negative levels. And not only do low interest rates encourage debt, they encourage refinancing, terming out of debt. So in other words, if you're holding a debt that is due to mature, let's say, if you say, let's put us back in 2020 for a start. Let's say you're looking at a debt that's going to mature in 2025 and you were paying a coupon of 5% on that. If you can get away with reissuing that debt for 2030 at 1% interest rates, you're going to do that. And so there was a lot of refinancing or terming out of debt during that period. And we're now in the unfortunate window where a lot of that debt is coming back into the system to be refinanced again, and arguably at higher interest rates as well. And you can see from the darker red bars on this chart where that debt maturity, how that debt maturity wall is building. Now, it may be more difficult to see that if you're looking at the levels. So what we're saying here is that by 2030, something like 45 trillion of debt in the advanced economies will need refinancing. This is the refinancing bit. It's not even counting the new debt that they're taking on. So this is the existing debt that's got to be rolled over. Now, if you look at the change year on year, that's the picture. And you can see very clearly what happened in 2021-22 when there was a lot of refinancing of debt that occurred. And so you see this interruption or the bite out of the chart that's very obvious. What we start to see from 2025 and is going to continue through 26 through 30 is a much heightened annual increase in debt refinancing. And that's going to put a strain on the system. Now, if we look back to this chart, this schematic diagram, this is really highlighting what we call the debt liquidity cycle. This explains why we have financial crises and why it's important to understand liquidity. A lot of people talk about concepts like debt to GDP. Well, that's sort of meaningless in a lot of ways. Economists like that because it's a convenient measure that they can come up with, convenient metric. But it doesn't really tell us very much. I mean, just evidence the number of countries that have got wildly different debt GDP ratios. Those debt GDP ratios have just trended high year after year after year, seemingly without any problems. Although, there's a lot of concern as they go up. But we were told, I think, back in 2008 or 2009, in a famous study by academic economists, that it was, I think the figure was 80% debt to GDP was the crucial number. And if we got above that, it was the end of the world. Well, we've sailed past that long, long ago. It's not debt GDP that matters, it's debt to liquidity, because debt needs to be refinanced. And if you look at this diagram, what it's telling you is that there are two legs to that refinancing. And the reason for that is that the paradox at the heart of the modern financial system is that debt needs liquidity to roll itself over, to be refinanced. But liquidity is collateralized borrowings, and it needs debt, good quality debt, basically as collateral. So, ironically, new liquidity rests on the integrity of old debts. And that's why the financial system cannot stand defaults and why policymakers will never let that happen. They'll always come in to bail the system out. Now, as you can see, the two legs are a refinancing leg on the right. And what it says is that today, something like 4/5 of all transactions in global financial markets are debt refinancing transactions of some form. And then on the left-hand side, we've got the repo collateral leg, which is turning debt into liquidity. And that is saying that 77%, this is a World Bank figure, of all global lending is now collateral backed. So you can see the importance of the collateral markets in lending. Now, what this is saying is to understand the collateral leg and whether that's going wrong, you've got to look at the move index, as we've discussed, and you've got to look at things like the SOFR spread, which is the repo spread against policy rates that the Federal Reserve is trying to set. And if you get significant dislocations in those, you've got a problem in the collateral markets. On the right-hand side, you see the refinancing leg, and that's saying, well, you can see things going wrong. Obviously, if credit spreads blow out, but maybe the private credit markets have actually distorted that process to some extent. They're hidden, it's hidden, but it may be deteriorating now. And bond term premia in the government markets, which is another heads up to what could be going wrong. And that is signaling to me that there is a building problem. Now, this chart is showing that ratio over time for the advanced economies. And what this chart basically says is that there is an equilibrium between debt and liquidity at about 2 times, that dotted line on the chart. And what that's saying is, as well, is if you breach that dotted line and go significantly above, let's say the 220s, 230s on that chart, you start to get financial crises. You cannot refinance the scale of the debt that is being asked. If you go below that dotted line, you get asset bubbles because there's so much liquidity, you don't need it to refinance debt. The liquidity is spare and it will find its vent in higher asset prices. Look where we've just come from. We've just come from something called the everything bubble. Why were we there? It's pretty straightforward. Every crisis that we saw in that period since the GFC in 2008, policymakers addressed by pumping more liquidity into the system. QE after QE after QE after QE. And that's what happened. On top, what they did is during COVID, they slashed interest rates to near zero. If you slash interest rates to zero, you're incentivizing more people to take up debt, but also encouraging this refinancing, and you create this debt maturity wall. Why does that orange line rise strongly? It's because liquidity is slowing down, it's cyclical, and the fact is that debt is exponential, so you're always going to get problems, of course, but the debt maturity wall is coming back, and that's what's explaining that process. Therefore, what we've got to watch are things like the move index, which you've spoken about, and you've got to think about whether that move index is rising significantly outside of its normal band, because if it does, it's very, very difficult to refinance. In other words, you can't turn debt into liquidity, and then you've got a problem. Or you look at the liquidity collateral imbalance evidenced by the repo markets by looking at things like the SOFR IRB rate. The IRB is the interest on overnight reserve balances set by the Fed. And if that blows out, you've got a problem as well with refinancing. So these are the issues that need to be addressed. Now, I'm going to show you this chart, which is the final one, and then I'll shut up for a moment. This is telling us that there is a problem. And if you read the media, and in particular, if you look at some of the insane comments that are coming out of press reports, particularly the Financial Times, which is telling you that it's the end of the world for the bond market somehow, they're not looking sensibly at what's going on. If you look at what's happening in government fixed income markets, you need to differentiate the implied policy rate that the central bank set that is embedded within the term structure of interest rates. And you need to distinguish that from the term premia. Now, what the term premia is telling us is that the term premia are shrinking across government debt markets. I understand that yields are going up, but yields are going up because the market is expecting policy interest rates to be increased. Term premium coming down simply because the appetite for risk in the system is diminishing. And if you look at this chart that I put in front of you, it shows global liquidity, which is the orange line, alongside changes in world bond term premium. Now, the reason I'm looking at the world is that this is not distorted by the US issuance calendar. It's generally looking at what bond markets around the world are doing. And bond markets around the world are clearly demonstrating falling term premium. And what that is saying is that is in line with what you'd expect and what you've seen historically from movements in global liquidity. Why? Simply because if liquidity is scarce, investors want security and safety, and they get that in government bond markets. So what they do is they bid for duration because that's where you're going to get some cover, particularly in a recession or a very severe financial crisis. And what's happening is that term premia are being bid down. In other words, bond prices are implicitly being bid up simply because investors are getting scared by what's going on. And that's the message of the bond market. So we're starting to see increasing tensions. The $64,000 question is not, will the Federal Reserve come back in? Is when will the Federal Reserve come back in? Because it will. We're just debating the timing.
Jeffrey Gundlach last week mentioned the scenario, what if yields rise in a recession because the quantity of US Treasury debt is so large? What would you say to that, especially as you're citing this fall in term premia? We've noticed, one of the ways that people can observe this in the market, easier than looking at term premia is the yield curve, 2s, 10s, for example. We see that declining associated with this fall. So what would you say to that argument?
Well, I don't believe it is the fact. I mean, the bond markets are big, the equity markets are big. If you start to see an asset allocation move from equities into fixed income, as you would expect to see at some stage, bond yields are going to come down. No one's telling me that the yield curve has lost its momentum or lost its cycle, and that would be the implication of what is being said here. So that would argue that as the economy turned down, as liquidity conditions tightened, the yield curve would seemingly steepen. I certainly can't see that. I mean, just to give evidence of that fact, look at this chart, which is looking at US liquidity, which is the orange line. It's our measure of an index of US liquidity conditions. And the black line is looking at the average yield curve slope. Now, the average is just simply the area under the curve. So it embraces tens, twos, and embraces fives, 30s, it embraces many, many different spreads. But it's giving an average, if you like, yield curve gradient. And what that's showing is it moves very, very closely with the liquidity cycle. In actual fact, the liquidity cycle has been advanced here by 9 months to show it's leading. And, I've looked at that relationship. I mean, it was the foundation of what we did at Salomon Brothers in terms of understanding the fixed income markets. And that has been, I've been using it since the late 80s. And it basically tracks, if you go well back into the 70s, you still see, in fact, where data pretty much began, you see evidence of this cycle. And it's very clear, and it's occurring because of term premia are the major drivers of the yield curve over time. And it's as straightforward as that. So I would be gobsmacked. In fact, I'd probably give up if you didn't see that black line start to inflect downwards. And one of the calls that we've had throughout this year is to say, probably our big call for 2026 was to say that we expected the yield curve to begin to flatten by the middle of this year. And it seems as if it's poised to do that. Now, we can be wrong, of course, but that would be, rewriting, the way that the world works.
TBL Pulse gives you interactive access to the information that powers our research, including TBL Liquidity, Johan's Bitcoin quantitative framework, and all the market data visualizations that we use to understand what's going on in macro. I've been using this terminal every single day, and I'm so excited that it is now available to all of you. If you're already a TBL Pro, you can access Pulse right now. If not, for the first time, TBL Pulse is now available standalone. Go to thebitcoinlayer.com to find out more. So I want to ask you then, last year you told us when we interviewed you that, people need to, if they're going to participate, to dance near the door. And right. that call turned out to be quite good. So I've been reading your stuff, and you're still talking about how gold and Bitcoin are going to benefit from this entrance of the Fed back into the market. So give investors now some actionable information in terms of how they should position themselves given the recovering economy, the continued investment in AI. I'm wondering if the cyclical topping of liquidity is really going to be associated directly with this multi-year investment cycle where money is going into the real economy coming out of financial markets. How do people position themselves, broadly speaking?
Well, I think the investment advice, Nick, I would give is don't trade Bitcoin or gold, own them. And it's really as simple as that. They should be part of a core holding because they're monetary inflation hedges. And we're moving into a world where the only thing the governments can do is to monetize the debt they've got. We've seen that very clearly on a number of occasions. We've seen that in the case of Japan recently in the last 10 years. What does everyone know has happened to Japan? The yen has collapsed. It would have been a fantastic investment for a Japanese investor to either have owned gold or Bitcoin through that period. Not just, in fact, their dollar values going up, but their yen values have gone up even more. What you're seeing happening in Japan, or what's happened in Japan, is happening right now in China. The Chinese are monetizing their debt. The gold price is going up, particularly in Yuan, but generally it's China is driving the gold price internationally as well. The Chinese are not allowed to own crypto, as you know, so that conduit is not available to them. But I'm sure that if they had the opportunity, and probably some do via Hong Kong, they take that. So what's happening in scale in Asia is happening in the background. This humming sound that you hear all the time is the printing press is going in the West. And as I said, if you just look at what's happening to the US deficit and US debt, you're looking at a monetization rate currently running at about 30% of credit growth is pure monetization of debt. I mean, this is a high figure, but it's happening all the time. And I come back to the point that, as I made many times before, we're not looking at financial repression. I mean, this is a crazy idea to suggest that this is what's going on. It's not financial repression. It's almost the opposite. It's monetary inflation. That's what you've got to be worried about. That's what's going on. That's the easy way out. It's not the government's, it's not the governments can control the rate of economic growth or the rate of interest. I mean, they can't. They don't have that power. The power they have is to print money. And so what the real threat is monetary inflation. And that's why you need to own these assets. And that's why, if you look over the medium term, the gold price has gone up it has gone up persistently, let's say, since year 2000. You're looking at a very, very significant outperformance of gold. What is it, up 12, 13 times since then? It would have been very difficult to trade gold, particularly as a retail investor through that period. Certainly looking back with hindsight, much, much better to own it. And I think the same is looking forward, and the same is true for Bitcoin. So that would be my investment advice. Trade other things for sure, but these are core assets. You don't really want to trade them because you might miss out.
Now, explain to us when you talk about the Fed coming back in, that it's not a matter of if, but it's when. Is that what? Yeah, is that what bottoms cyclical liquidity by your measures? And if you're, you citing China is already monetizing the debt, why isn't that showing up in your global liquidity index?
Well, I mean, the answer is that it is showing up in the global liquidity index, but other things are occurring alongside. So the overall picture is such. The evidence for China. Let me go on to show what is happening in China. And this, by the way, before we get there, this is the movements in our global liquidity index against a basket of Bitcoin, Ethereum, and Solana, which is the BES dollar. And what we've looked at here is 6-week changes purely to take the noise out of the data. And global liquidity has been advanced. That's the black line on the chart by 13 weeks. Now, I'm not going to sort of put my hand on the block and say that, hold me to that prediction. But I'm saying that broadly speaking, it tends to be a pretty good guide to understanding what's going to happen to monetary inflation hedges, in the short term or medium term. I would find it dangerous to trade Bitcoin in an environment where I think there is a secular trend towards more and more monetary inflation. Because, in the end of the day, if you're out for a significant amount of time, you could lose out. Nonetheless, it's worth understanding the risks that one's running. In terms of China, this is what China is doing in terms of its daily liquidity injections into markets. This is actually the year-over-year change of all liquidity injected through various programs by the People's Bank of China, PBOC in other words. And this is the annual change from a year before. So this is not the level, this is the change in their activity. And you can see there's been a noticeable step up lately, and they're injecting at the rate of pretty near $1 trillion a year of extra stimulus, which is sizable. And I think they're going to have to do the same this year as they did last year. So this, we're looking at sizable amounts of cash. What effect has that had? What effects that has had has been on the Yuan gold price. And as I say, China's just doing what Japan did before that. And other countries in smaller measure will be doing what China has done and following that same route. So what you're looking at here is the Yuan gold price. And what I've tried to argue is that that's the way to understand gold, not to look at it in dollar terms, look at it in Yuan terms, because China is the marginal buyer. And it looks as if it bottomed at 30,000 Yuan recently. I think that the targets have been set almost at $5,000 intervals. I may be wrong, but that's what it seems to be. So you've gone 15, 20, 25, 30, 35, etc. I think that the next move will be upward strongly, but I think that that has got to be a bellwether or a marker, benchmark, if you like, for what's generally happening in monetary inflation hedge assets like gold and Bitcoin. And if you want further evidence of that, just take a look at this chart, which looks at the gold price shown in orange in US dollars and the liquidity injections by the People's Bank, which is shown in black. And I would say that there's an association, a clear association between those two data series. The reason that you've had a strong gold price is not necessarily because of debasement in the West yet. It's all to do with debasement in China now. And that's the reality. That would have moved into Bitcoin, in size, had the Chinese been allowed to buy Bitcoin.
Interesting. Now, when we talk about the Fed coming back into the market and, essentially you're guaranteeing that you're all but guaranteeing that the Fed will eventually have to monetize the government debt. Is it possible that the monetization happens completely outside in the private sector, as we discussed earlier in the interview, through Treasury monetization or even buying out the rest of the curve? Or is it going to be the Fed? Is that the mechanism that it has to happen through?
Well, I think it's a good question. I think my view is that the private sector is just not able to do that. What you've got to remember is that there's a very limited interbank market. So the question is, who is going to support banks that are in trouble? And the marginal source of liquidity for banks, if they get into trouble, I'm not suggesting they will do, is going to be the Federal Reserve through, lender of last resort facilities. But then you've also got to say, well, actually, at the margin, most of this lending has already occurred directly or indirectly through the fixed income markets. And it's the fixed income markets that are more vulnerable. And the Federal Reserve really has to step in there. And the problem with the fixed income markets is that that in terms of government markets alone are, I think, between 5 and 6 times their size in the GFC 2008. So in that short space of time, what are we talking about? Between 15 and 20 years, what you've seen is outstanding federal debt 5 to 6 times bigger. The dealer capacity of banks, in other words, the ability of the banks to deal in bonds, their capacity has shrunk by 50%. So you can see the stretch that's there. And I just don't believe that the private sector has the capacity now to support the bond markets in times of serious worry, in terms of serious tension. And therefore, the Federal Reserve has to go in. Now, I would surmise, and I don't know this, but my supposition would be, is that there's a lot of focus in the Treasury and the Fed on things like the MOVE index. And I think there was, and I'm reasonably sure in saying this, that there was an attempt to try and bring the MOVE index volatility in the bond market down significantly over the last 12 months, which they've done quite successfully through various mechanisms. And that may have been a combination of bill issuance, it may have been a combination of buybacks for the Treasury, but they seem to have done it quite successfully until recently. There's been a spike, but I would think that is one of the policy factors that they will be, or one of the policy targets that they would set themselves. So, at the end of the day, whatever sort of the stripe of one's politics, the fact is that the Federal Reserve's job is to control the bond markets or to ensure the integrity of the bond markets, not to fight inflation or to create employment. Those are secondary mandates. The ultimate goal is integrity of the sovereign bond market, because that's the heartbeat of the US economy. If the Treasury market folds, there's big problems. Just look at the alacrity with which the Bank of England switched from QT to QE when there was the Liz Truss moment back 3 or 4 years ago. That's they changed overnight. Easily happened. And that's the question. So if you've got problems in the bond markets, and I suspect that at some stage you will, if these private credit problems sour further, which may be the case, I don't think there's a major default risk right now. There's certainly a big illiquidity risk, which is a different question. Looking at the supposed runs on some of these share prices and the ability to get locked up credits out, there's an illiquidity problem for sure. That could turn into a solvency problem later, and that may be an avenue that we need to explore. Ultimately, the Federal Reserve will have to come back in and support the system in some measure.
So if I'm thinking about what you're saying, and I'm looking at this debt liquidity cycle here, my eyes focus in on credit spreads. That credit spreads would be the tell, and that's what you're trying to explain to us, is that that's what we should be watching. Trouble in the fixed income market. Are you talking about credit spreads here, or are you talking about global sovereign bonds or treasuries? Because I just want to be specific here. If term premia is falling, it means that there's a demand for treasury duration as
Safe
things
assets,
go,
there's demand
a,
for safe assets.
a demand for safe assets. So is the red flag here widening credit spreads in this particular scenario that we're discussing?
Well, the red flags or the red lights are any one of those four factors. So it's a spike in the move index, which interrupts the transformation of debt into liquidity. It could be a spike in SOFR spreads, which interrupts that process as well. It could be a fact. It could be term premium crashing, in other words, falling, which is saying that there's a big demand for safety and the ability to refinance debt. There's no appetite for refinance debt, or it could be a reflection that you've got credit spreads that are suddenly widening. The thing that bothers me at the moment is that we're starting to see little ruptures in each one of the, well, I'm going to say in 3 out of the 4 markets. Credit spreads have moved up a bit, but not seriously. But one of the questions that hangs over the debt markets and the corporate credit market is whether private credit has actually created such a scarcity of listed bonds that credit spreads are no longer the signaling device they once were. And I don't know, I'm not an expert on the credit markets to read the past judgment on that, but it's clearly a consideration.
What is the real downside then to the private credit situation right here? You mentioned liquidity and not defaults is the concern. Can you discuss some of your analysis on private credit and your outlook there and its impact on the financial system? Because really, bank defaults then would be the trigger for contagion. Am I correct there?
Well, I think the issue is that, that insolvency really follows from illiquidity problems. And if you look at what's happening, there doesn't seem to be a major insolvency problem there. The credit funds, I'm speaking generally rather than specific cases, because specific cases may be imprudent. But generally speaking, they've got fairly decent equity cover, and it would take a major crisis to actually turn those into insolvent vehicles. The problem they've got is that there is illiquidity. So if you've got a rush for investors to get their money out and you gate the withdrawals, then you're sort of creating a queuing system, and you tend to create panic or sort of bank run. Now, the difficulty there is that it becomes very difficult to actually getting more money into these funds. What's more, big institutions read the headlines and they think, well, actually, do we really want to support these private credit funds anymore? No, we don't. So we're going to start paring back our allocations to private credit. And so what you tend to find is that this thing feeds on itself. When push comes to shove, when you do need a major refinancing, the capital is not there. And that's when you get a default. So it may not be that these companies actually run into, they don't run into a brick wall themselves. They just can't get the finance from the markets because they're tainted. And that's something I think to watch out for. But it's something that the company that may be further down the road.
All right, I still have a couple quick questions left for you. I want to ask you about this wave of AI investing that we are in the middle of. Is that directly associated with or happens to line up with the fall in the global liquidity cycle as money will go into the real economy and out of financial markets?
It's certainly a factor. I mean, there's no question about that. There's actually, I've got a chart, which this one here, which is basically looking at the global liquidity cycle inverted, and that's the dotted line there. And the orange line is basically illustrating the demands on US capital markets estimated this year, including the AI spend and funding from the government. So you can see that, and this doesn't include the extra defense spending on the Iranian mission. And what that's basically saying is that, we were looking anyway for 2026 to be quite a big year in terms of demands on capital markets. And this, remember, is new funding. This is not the rollover. This is just the new bit on top. So you can see that this is fairly substantial fairly substantial increase. I mean, pretty much a doubling from where we were in 25.
Very interesting. Okay, so we heard you say over and over today that money that comes out of the real economy can go into the financial markets and vice versa. Money that goes into the real economy necessarily comes out of the financial market. So this relationship of inverting global liquidity and associated with demands on US capital markets, which includes the private sector and it includes deficit spending. It's an important relationship here to drive home. So now I want to ask you about the Fed's balance sheet itself. It's turning back up as the Fed starts to do more reserve management purchases. It's buying bills. Now give people more of an explicit projection here. When does the Fed start to really get going on its balance sheet, or do you feel that pace is already with us? When will it go from bills to the rest of the curve? Will it stay in bills or go to the rest of the curve? Give us the most specific projection here on the Fed's balance sheet. And is it going above 10 trillion in the next few years? I'm really curious your thoughts.
Well, I mean, what we've got here in this chart is growth of Fed liquidity. And Fed liquidity is a concept that we devised many years ago, which is basically looking at the liquidity creating parts of the Fed balance sheet. So, as I keep saying, it's not the overall balance sheet that's important. It's looking at those elements that are important, those factors that actually create liquidity in money markets. And this is what this is showing the growth. Now, you can see if you just eyeball that chart and associate the cycles with what's happened in the markets, why looking at Fed liquidity is so important. What you can see at the beginning of 2026 is a surge upwards, and that is basically because of this new RMP program. It has an effect, there's no question, but you can see that it tails off through the back end of the year. And so the growth in the Fed balance sheet does start to come down from what are currently very high rates. Now, I would also stress that, there's a lot of other things going on besides the Fed. And if the Fed can be positive here, but it can be outweighed by other factors. And seemingly it is. Okay, so as I said earlier on, central banks are not changing the tempo, particularly of their liquidity injections overall, but it's really the private sector that's falling away because of increasing demands from the real economy that's sucking money out. So what we're looking at here is a Federal Reserve that is currently running at quite a high ebb, but it's slated to slow down further if you believe the Fed story. Now, that's really the question to pose. And at the moment, I mean, we've got no other evidence to suggest otherwise. So I'm looking at what the Fed is telling us, and this is what they're planning to do. It could clearly change. Why is it important? Because if you look at this chart, which is a tad out of date now, I've got to say it was done last month, but what it shows is movements in Fed liquidity in red. So this is in absolute amounts, not the growth rate. And the orange is the S&P 500. Now you can eyeball that chart and see that it actually, broadly speaking, with some poetic license, aligns itself to fluctuations in the S&P. But Fed liquidity has been advanced by 25 weeks. So, that's something like, we're talking here about almost 6 months, generally speaking. So there's that sort of lead time on the market. Now, at these high elevated levels of the market, you got to say it's been vulnerable to that setback in Fed liquidity that we've been seeing. And that little dotted line projection, the sort of belly flop, if you like, on the chart, is what is happening right now, even including the RMP, the proposed RMP. So that's what the Fed is trying to do. It's kind of flatlining its balance sheet. And the orange line has already come down markedly, as you see, since that point of end of last month when, you should say the end of the month before, it was plotted. So I haven't done the end of March yet, but that's just showing, giving you some indication. This is a monetary policy for a flatlining market at best. Okay, it's not a monetary policy for a bull market in equities.
Michael, give people your takeaway. You mentioned gold and Bitcoin as holding positions, not trading positions. How should people think about the next 12 months in all of this, current geopolitical chaos? And how should they be thinking about the future in terms of their portfolio from your perspective?
Well, I think the first thing to say is that it's all about looking at the cycle in liquidity. I'm going to show you a chart which illustrates that now. So this is the global liquidity cycle ex China here. This is for the advanced economies, and it's basically showing this 5 to 6 year rhythm in global liquidity conditions. We're in a downswing of that cycle. It will likely bottom in 2027. So we're looking at some way away, and I would say don't get your hopes up for a rebound in the near term. Things can change, and as I say, if the facts change, we're all allowed to change our mind. The fact is the facts are that nothing's changed yet. But watch this space. It could be that the Federal Reserve decides to follow the course I suggested it might and do a lot of bank deregulation while keeping the Fed balance sheet high. That's possible. That could give us a window for more liquidity. China is not shown in this chart, but China is expanding its liquidity. But China is very different from what you're seeing in the US. And I think I've got a chart, but it's probably a little bit further on, which is here, which is showing the differences between the US and Chinese liquidity cycles. And you can see really since 2020, they've been completely asynchronous, desynchronized 100%, acyclical, if you like. And what that is demonstrating is that the US liquidity cycle is coming down while China's is going up. And China is trying to get its liquidity cycle higher. They've got big problems in the Chinese economy, as we've alluded to, and they need to dig themselves out. And monetizing debt is probably the main way of doing that. And that's why the gold price is going to go up. So if you think that gold is a very good proxy for general monetary inflation hedges in the world economy, including Bitcoin, then I think things are looking pretty rosy.
Michael Howell, CrossBorder Capital, thank you so much for your expertise today, sharing your charts, sharing some investment advice. We, of course, don't give investment advice here at the Bitcoin Layer. Please do your own research. We appreciate you. Please tell people where to find your excellent work.
Well, thank you, Nick. It's been a pleasure. If you use Substack, we are on Substack under the title Capital Wars. That's our regular publication. We publish 3 to 4 times a week. Both narrative and data are available on there. Or if you want our institutional service, where we provide a lot of data for institutions, quant funds, etc., that's glindexes.com.
And we are on Substack at thebitcoinlayer.substack.com. Go check out CrossBorder Capital's excellent Capital Wars Substack. Michael Howell, I'm Nick Bhatia. We'll catch you guys next time.